So good evening. So there's a question niliwapea mlifanya hiyo swali. So let us check something on the cash budget. We do something brief on the cash budget. So I want us to revise something brief on the cash budget. So when it comes to the cash budget, we shall be able to see it as one of the items we normally use so that we can be able to forecast what is the expected cash flows. So we shall be checking how to prepare a cash budget. There is one question in your past paper in relation to that, which I'm interested in. But first, let us see what we mean by the cash budget. Let us see what we mean by the cash budget. We want to see what we mean by the cash budget. So for the cash budget, we can just summarize that it is a statement. It is a statement showing the projected actual cash inflows and outflows. The projected actual cash inflows and cash outflows. Actual cash inflows and the actual cash outflows for a defined period of time. For a defined period of time. For a defined period of time. It records only the actual cash outflows and inflows. It records only the actual cash outflows and inflows. It records only the actual cash outflows and inflows. Therefore, non-cash flow items, the non-cash flow items like provision for depreciation, and bad debts are normally ignored. And the bad debts are normally ignored. Then another paragraph is that the main purpose of the cash budget is to, number one, coordinating of the activities in the organization. Number two, for planning purpose. Then number three, controlling and motivation purpose. Number three should be controlling and motivation purpose. For controlling and motivation purpose. So there is a question in your past paper in relation to that. So let us check a question for May 2017. Question 3, part A. May 2017. Question number 3, part A. So you can check May 2017, question number 3, part A. May 2017, there is a question number 3, part A. So that question for May 2017, question 3, part A, they said that the following information relates to Suma Enterprise Limited. So for the 4 months given below, so they have given the sales from September, October, November, and December. So all sales were made on credit. Half of the debtors are expected to pay within the month of sales and are also expected to claim a 2% discount, cash discount. The remaining debtors are expected to pay by the beginning of the following month. They are expected to pay by the beginning of the following month. So raw materials are given. The farm plans to pay creditors in full in the month following that of purchases. Then additional information, all employees are paid in the month in which the wages or salaries is earned. The note number 2, rent of 10 million for each quarter is paid in March, June, September, and December. Then other cash overheads will be 2 million shillings payable each month. Then note number 4, a new plant for due delivery will be paid in November. Then in October 1st, the farm had 10 million in the bank. So required was simply the cash budget. Required, they wanted you to come up with the cash budget. So before we prepare that cash budget, we shall first prepare debtors collection schedule. We shall be able to prepare the debtors collection schedule. How cash was collected from the credit sales. Then in the process, we shall see what we can get from there. So this now our debtors collection schedule. This should now be the debtors. We want to see how to prepare the debtors collection schedule. The debtors collection schedule. So we shall be having the month of September. I'll have September, October, December. So the question had given you the sales, the credit sales. The question had given you the credit sales. The question had given you credit sales. So September it was 60 millions. October 60 millions. That have also given you November 70 millions. Then you see December it was 90 million. So that is what the question has given you. That is what has been given in the question. So that's now the credit sales. Then now from there, we want to see how cash was collected from the credit sales. We now come up with cash from the debtors. So credit sales are our debtors. Credit sales are normally our debtors. So now we can have cash from the debtors. Now come up with the cash from the debtors. So how do they collect the cash from the debtors? I want to see how to collect cash from the debtors. So you can see in that paragraph, we see that a half of the debtors are expected to pay within the month of sales and are also expected to claim a discount of 2%. The remaining debtors are expected to pay by the beginning of the following month. So 50% is in the same month. 50% same month. But they claim a discount of what percent? They claim a discount of 2%. That means after that, you reduce them by 2%, multiplied by 98%. We are reducing them by 2%. Then the other half is also 50%, are expected to pay by the beginning of the following month. So 50% is after 1 month. 50% after 1 month. So these ones, they will not claim any discount. Those ones will not claim any discount. A half is paid in the same month, but now you claim a discount of 2%. So we start this figure. You see the 60 million? So 50% of 60 million to give us 30 millions. Then once you get that 30 millions, multiply again by 98%. Multiply again by 98% to reduce them by 8%. So get 50% of 60 million, which is 30 million, then also get 98% of that figure, which is going to be 20 what? Exactly 29. 29.4. Exactly 29.4. Yeah. So the 29, so 29.4 million is now received in that same month. 29.4 million. Then another 50% of the same figure. You see that the other 50%, after 1 month, it is 30 million. We go there like that. So the 50% of 98 is in the same month. The remaining 50% of the same figure will go to October. So this is now for this one here. That is now for that. Then we go to this one again. We go to that. So 50% of the same and 98% will also be 29 because it is in the same month. Then the remaining 50% is that we go to the next month. So 50% of this figure, it is paid in the same month. 50% of that same figure is paid after 1 month. It comes to that point. Then you do the same for this one. 50% is in the same month, but we reduce it by 2%. That's why we have it there. The 50% comes to this. Now we come to 70. We also come now to 70. What is 50%? Also multiplied by 98%. So then 34.3. How about the 50%? The other 50% should be. So 35 will come to this point. 35 will come to that level. Then we go to 90 million. So also get 50% of 90 millions. When you multiply by 98%, it comes to 44.1. So we don't have January, so we ignore the other one to go to January. So now after that, I want you to get these totals. Now get those totals. Because I cannot respond just tonight. So that was the only working that you are to come up with. So after that working, we can now prepare the cash budget from that working, we can now prepare the cash budget. We can now prepare the cash budget. So it was for how many months? For 3 months ending December. So that means we start from October, November, and December. So we start with October. So we normally start with the cash inflows. We normally start off with the cash inflows. So cash inflows, it was only one. We start off with what is supposed to be the cash inflows. Start off with what is supposed to be the cash inflows. So it is only one, the cash inflows, only one. So will be cash from the debtors, cash from cash from the debtors. So it is only one. It is what we refer to as cash from the debtors. So how much have you added for October? So 59.4. How much is there for November?
64.3.
64.3. Then how much was there for December? Sorry? 79. So that is now our cash from debtors. That now should be able to give you the cash from the debtors. So if there was any loan amount, we could have recorded it as part of the cash inflows. If there could be any sale of the fixed asset, we could have included as part of the cash inflow. So if there is any loan amount, loan received, you record it there, loan received. But now the question had no loans for that. In case there is any sale of the assets, sale of assets, we also record it there. But now the question had no those values. So once you add them together, you will come up with the total cash inflows. We normally come up with the total cash inflows. But now it will just remain the same because there was no value for that. So this will just remain 59.4 million, 64.3 million, 79.4 million. That's now for the total cash inflows. Then now we go to the cash outflows. We should now get the cash outflows. Cash. We should now get the cash outflows. So for the cash outflows, Someone is asking why we did not include September. The question, when you check under required, just read what is there under required. Are you able to see the required part? Just read the required part. The required was the budget for 3 months. We only do what is specified by the question. So we only do what is specified by the question. So now we go to the cash outflows. So cash outflows, we start with the purchases. The cash outflows, we start with the purchases. And December 79.1, not 4. This is 1. This one, they're saying it is 1. So now for the outflows, we start off with the purchases. We start off with the purchases. We start off with purchases of the raw materials. So when you check down there, they say that raw materials purchases, where you are given September, October, November, and December. So the farm plans to pay its creditors. Creditors are our suppliers of the raw materials. They plan to pay the creditors in full in the month following that of purchases. So you pay after 1 month. They pay the month following the month of purchases. So when you check what we pay in October is what we are able to buy in September. So they have stated that the farm plans to pay its creditors in full in the month following that of what? Purchases. So when you check through the purchases, now the one for September is what we shall pay in October. So this one will be paid 20. Yeah, we shall be able to pay 20. The one we pay in November should be the one for October, which is how much? Which is 40. The one we pay in December should be the one for November. It is also how much? 40. That is what is the information is provided. That's the information provided. They plan to pay creditors. Creditors are our suppliers of the raw material, which is the purchases. So they pay after 1 month. The one they pay in October should come from the purchases of September. The one we pay in November should come from the purchases of October. The same case for that. So that's now for the purchases. The other expenditure was wages and salaries. You can see the wages and salaries. So wages, but when you go to the note number 1, you see note 1. All employees are paid in the month in which the wages or salary is. And so that one there is no adjustment, wages and salaries. Wages and salaries. So you just record them the way they are. October, it is 15. November, it is 17. December, it is 30. So those ones, they were not requiring any adjustments. The next one is meant to be in the note number 2. You can see what is there in the note number 2. Rent of how much? 10 million for each quarter is paid in March, June, September, and December. So now we factor in the rent. We factor in the rent. So that rent, they pay quarterly. So we only indicate in the month that are indicated for our budget. So they have said that March is not in our budget. they have mentioned about June. June is not in our budget. September, it is not in our budget. The only month which is in our budget is when? December. So the rent, we only record it in the month of December because that is now within the period. So that amount is 10 million. That amount is meant to be 10 million. So there is no other element for the rent. So rent was paid quarterly and March, June, September, and December. So the other months are not within our budget period. So we only record in the month of December. The other item is in the note number 3. Note 3 is about cash, other cash overheads of 2 million per month are payable. So we now also include overheads. Now also include overheads. So this one is paid monthly. It is paid monthly and every month they pay 2 million. So you record 2 million each month. 2 million each month. So overheads, they are paid each month. The other item is in the note number 4. A new plant due for delivery in September will be paid in November at a cost of 25 million. That's now cost of the plant. Cost of the plant in the note number 4. So cost of the plant in the note number 4. So that cost of the plant is 10 million and sorry, it is 25 million. It will be paid in which month? November. So you record it there. It is 25 million. So I'm not using the note number 5 now. So I want you first of all get this total cash outflows. I want you first of all get the total cash outflows, subtract from the inflows to give me the net cash inflows. First get those total cash outflows. First of all, get those total cash outflows. Then you will subtract them from the inflows to give us the net cash inflows. So get those total cash outflows, subtract them from the inflows, get the net cash inflows. So you subtract those outflows from the inflows to get the net cash inflows. You subtract the outflows from the inflows to get the net cash inflows. Subtract the outflows from the inflows to get the net cash inflows. So when you subtract the outflows, so outflows from the in October, they are saying it is 27.6. 22.4 after subtracting. So they are saying it is 22.4. How about November? 19.7. 19.7. Then the one for December, 14. So now we go to the last note. You see the last note, they said that on 1st of October, the firm plans to have how much in the bank? 10 million. So on 1st of October, that will be the opening balance for the month of October. I had simply asked you to subtract the total cash outflows from the inflows. All those items that were down here were the outflows. They were to be subtracted from what we calculated up there as the total cash inflows. You are just meant to subtract these total cash outflows I've indicated here from the total cash inflows we had indicated up there. So that is now what was to be. So are those the figures? So now from there is something given to you in the note number 5 on 1st of October. That will be the opening balance. So we should be having opening balance, which is given as 10 million. When you add now that opening balance, which is 10 million, you now get the closing balance. Which will now be 32.4 million. Then also the closing balance for October is the opening for November. This closing balance for October, the opening for November. So we get the total. So it should be which field? Sorry. This will be 12.7. Is it 12.7? So also this closing balance for November will be opening. Like that. So now gives us which value? Sorry. So this now your cash budget. That now will be your cash budget to show how much is there as the cash inflows. That is now your cash budget to show what you have there as the cash inflows. So now after that, I want you to go back to your handout. I want you to go back to your handout. The one for the management of the working capital. The one for the management of the working capital. So they are saying it's time for the prayers. So we can give them 5 minutes. We can have a short break, then we come back.
So we get like related to the cost. The professionals be right. And yeah, that's inakachukua kwanza kipaketu alichoja J JCB system. You can do anything here. It has jobs here. Not to have CBS. That's so cool. So, at 25 years, something like that. Before 7:30, the one in the spread. I have an assumption before, but I just except for but no. So you need 7 days. Of course, so you have this cable. People buy that I want us to use that. It's okay to use it. Saturday, hiyo ndio kitu ya kwanza kusema. Actually, organization ilikuwa organized. So kasema kwa sasa kuna kusema tati. Moja pia kwa hivyo kidogo napigiwa sasa kesho kesho kanisa nilienda kwa shule ndio nifanyie training hii nilienda kwa hivyo sasa nilipeleka kesho training kesho ndio Nini mtakumare sema again to me having a kid saying is a priority and wow they don't want lakini hiyo ndio tofauti za watu kama ni mkuu wetu hata mjumbe anatumia ndio zake
So when you check through that small handout, I simply want to check some few details about debtors or accounts receivable management. So that should be on page 5. That should be on page 5. So when you go to page 5, there is something about debtors or accounts receivable management. So debtors or account receivable normally result from the credit sales. So company normally sell on credit due to the following reasons. So why should the company sell on credit? They have listed all of them for you. Number 1, in order to increase the sales volume. Number 2, in order to avoid stock from getting out of fashion. Number 3, in order to maintain existing customers and acquire other new customers. Number 4, in order to avoid fluctuations in the prices. Number 5, in order to enable customers to take advantage of the quantity discount. Then the amount of the account receivable outstanding at any particular period depends on the following factors. It depends on the following factors. So M, volume of the company's credit sales. Then B, the average debtors collection period. Then they have talked about average debtors involve credit risk management, which refers to the process and controls that the company has in place to ensure efficient collection from the debtors, and it normally includes the following. There is credit selection, there is the credit standard. So for the credit standards, you can see 5, 6. Now, we look at the character, the capacity, collateral or security, condition. Then that's now number 2 about the credit standards. Number 3 is the credit terms. So that is the place I want you to have a note on. I want you to check that part of the credit terms. So credit terms involves setting out the credit period allowed and any discount for offer for any earlier payment. So credit terms may involve terms like 2/10, net 30. So you can get a term like that one, where i.e. 2 will be the discount. 2% discount will be offered when payment are made within the first 10 days. Then otherwise, the full amount must be paid after how long? 30 days. So in this case, 2 is the discount rate, 10 is the discount period, and 30 will be what? The credit period. So you will be getting most of the details on that question. We'll be getting most of the details on that area. You will be carrying out the term. So when you get this term as 2/10, when you get a term 2/10, so the meaning of that term is that 2 is the discount rate. It is normally in form of percentage. Then 10 is the discount period. It can be either days or month. Then now 30 is the credit period. 13 should be the credit period. So I will simply do a question in relation to that. The rest of the details you should be able to go through and read them. So the question I want us to check in respect of that, the question I want us to deal with, question I want us to deal with we start with the one for September 2021. Question number 4, part C. 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 So that question 4, part C, that question number 4, part C, they have said that Upesi Wholesalers Limited deals in the sale of the foodstuff to retailers. They deal with the sale of the foodstuff to the retailers. So owing to the economic depression, the firm intends to relax its credit policy to boost productivity and sales. To boost productivity and the sales. So the firm current credit policy is net 30. So net 30, that's the credit period. Net 13 will be the credit period. And the average debtors collection period of 45 days. The current annual credit an amount to 60 million. So the firm intends to change to net 60, with the sales are expected to increase by 25%. Credit and debt analyst cost will increase from the current 2% to 2.5%. Bad debts will increase from the current 1.5% to 2% of the credits. Variable cost will amount to 75%, and return on the asset will be 12%. Assume there are 360 days in a year. So advise the company whether to change or adopt the new credit policy. So normally in that question, we just prepare the income statement. We just prepare the income statement so that you check before and after what is that particular profit. Before and after what should be that particular profit. So let us just prepare the income statement. We simply prepare the income statement. We just come up with the income statement like that. So in your income statement, you have before the change, also after the change. So before the change, also after the change, also after the change. So we create two columns, the one before the change and also the one after the change, and also after the change, and also after the change. Yeah, we are not doing part A, we are doing question 4, part C. We are doing the question for September 2021, question number 4, part C. We are doing question 4, part C. So we start off with the sales. We start off with the sales. Start off with the sales. So those sales were given. The sales were given. You see the current annual sales. Before they were how much? 60 million. You have them as 60 million. I will have 3 zeros at the top like that. So before it is 60 million. Then after, they said it was meant to increase by what percent? 25%. So when they change the policy, I would like you to increase the 60 million by 25%. That means that you get 125% of the 60 millions get 125% of the 60 millions. So this one will be 75 millions. We have 3 zeros at the top. Then, after that, we less the variable costs. Variable costs were given. You see, before required, they said that variable cost account for what percent of the sales? 75%. So less the variable cost. Less variable cost, which is 75% of those sales. So what should be 75% of the 60? So this one will be 45 millions. Also, what is 75% of 75 millions? So 56, 250. So when you subtract, you now get the contribution. Now get the contribution. When you less, you will then come up with the contribution. So how much is the contribution before the change? So this one will be 15. This one should be which one? 18. So some questions, they may give you contribution. They may say that the contribution is 25%. So if contribution is 25%, it means the cost of sales is 75%. So if they give you the contribution of, let's say, 25%, know that the cost of sales is 75%. Now you less expenses. So after that, you less expenses minus the expenses. Less the expenses. So for the expenses in that question, one of the expenses they said there was credit and debt analysis costs. So there is credit and debt analysis costs. So the first one we can have it as analysis costs. Debt analysis. So they have given you the debt and the credit and debt analysis cost will increase from what? 2%. You can see 2% to 2.5% of the credit sales. So here we assume all the sales are on credit. So that first one, simply get 2% of the 60 million. Simply get 2%. 2% of the 60 millions. 2% of the 60 millions. So what is 2% of the 60 millions? $1,000. The other one is what percent? 2.5. Also get 2.5% of 75. Also get 2.5% of the 75. 1875. Then the other cost there, you can see also another cost, bad debts. The other cost is meant to be bad debts. The other cost is meant to be bad debts. So bad debts, they have said it is going to increase from 1.5% to 2% of the credit sales. So you also now calculate that. So bad debts, the first one is 1.5%. 1.5% of the credit sales, which is 16. This one will be 900. Then the other one is meant to be what percent? 2%. 2% of 75. 2% of the 75. Sorry. So this one will be, if there is any other expense, you include it. They may say discount, but now this one, they cannot give you any discount. But there is another item which you should also be able to know. There is another item we refer to as opportunity cost of the debtors. Remember, you have sold goods on credit. So if this person could have paid you, that money could be in the bank earning you interest, but he has not paid you. You are losing that interest. So we refer to it as the opportunity cost of the debtors. So there is a formula I will give you on how to get the average debtors. So maybe you can jump like maybe 4 lines. You will write the formula for the average debtors. So average debtors, let the average debtors. Average debtors are supposed to be given by the credit sales. The credit sales multiplied by average collection. The debtors average collection. Average collection period. Then you divide by number of days in a year, if it is given in terms of the days. Number of days in a year. So when you want to calculate the average debtors, simply take credit sales multiplied by average collection period. Average collection period divided by the number of days in a year. Divide by the number of days in a year. So once you get those average debtors multiplied by the interest rate. Interest rate is the same as the cost of capital, so that we get the opportunity cost of the debtors. So once we have done that, we now factor in what we should be referring to as the opportunity cost of the debtors. Opportunity cost of the debtors. Opportunity cost of the debtors. So to get that opportunity cost of the debtors, from the formula I've given you, you simply take the credit sales. So credit sales here, they are 60. So there are 3 zeros at the top, multiplied by average collection period. You can see in the paragraph number 2, paragraph 2, they have said that the firm's current credit policy is net 30, and average debt collection period is how many days? 45. So you multiply by 45 days, divide by the number of days in a year. They have said there are how many days in a year? 360. So this will give you the average debtors. Once you get the average debtors multiplied by the interest rate is the same as the cost of capital. You see the return on assets. The return on asset of 12%. So get 12% of that figure. Get 12% of that figure. That's now the opportunity cost of the debtors. Interest on the debtors that you are actually going to lose. More than 900. So this one also 900. Then we also check after the change. So after the change, you also take those credit sales, which is 75. Multiplied by average collection period. Average collection period, they say that the current annual credit is 16. The firm intended to change to net worth, where the sales are expressed. So that net 60 is now the new one, the new average debtors collection period. So up there, they had said net 30, but the average debtors collection was given as what? 45. So when they give you the net 30 and the average collection period, we use the average collection. But when they just give you net, it means the credit period is the same as the average collection period. When they only give you the net, it means that the credit period is also the same as the average collection period. But if they separate them, you use the average collection period. So for this one, we just use that net 60. So multiply by 60, also divide by 360, then get 12% of that figure. Get 12% of that value. 59. So now you will subtract these expenses. You subtract those expenses from the contribution so that you get the earnings before the tax. So that you get now the earnings before the tax. So that you get the earnings before the tax. So that you get the earnings before the tax. So that you get the earnings before the tax. So the question did not give you the tax. If they would have given us the tax, we could now have subtracted the tax to get the profit after the tax. But the question did not give you the tax. So hii ya kwanza inakuja ngapi? Hiyo nyingine inakuwa so you see, there is no tax. If there was tax, we could have subtracted the tax to get the profit after the tax. But now the question did not give you the tax. So now we compare the two profits. You see the profit after the change is higher than the one before the change. So the advice would be that change the credit policy. Their advice would now be that change the credit policy. Change the credit policy as it will lead to an increase in the profit. Change the credit policy as it will lead to an increase in the profit. Change the credit policy as it will lead to an increase in the profit. So you also indicate that increase in the profit. Always indicate the increase in the profit. Where you take 13, take 75, subtract the 12. So always indicate the increase. If there is a decrease, you advise them not to change. You advise them not to change. So that is now the area I wanted you to know. If they come to that kind of a question, just prepare a schedule before the change and after the change. You get the sales, but then you minus the expenses. So that's now a format, just in case they test a question on that. So there was a question in the last sitting, which I'm not going to do now, but if you get time, that question was meant to be April. There is a question for the sitting of April 2022, question 2, part B, April 2022. There is a question number 2, part B. I will just go through the question. I explain some few things, then you go about it. So in that question, maybe we can just go through the question where they have said that the following information relates to Triplex Limited, where they say that the company has annual sales revenue of 6 million. So currently it is 6. All sales are on a 30-day credit, although customers on average take 10 days more than the recommended 30 days to pay. So contribution represents what? 16%. So if contribution is 60%, cost of sales will be 40%, isn't it? Yeah, so you'll be subtracting 40% as your cost of sales or variable cost, so that you get now your contribution. Then they continued and said that sales, and the company currently has no bad debts. Account receivable financed by overdraft at an interest rate of what percent? 7%. So you see here the average debtors. You see the interest opportunity cost for the average debtors. You will use, so where there's 12%, you'll be using what? 7%. Apply that 7%. Then in the note number 3, Triple Limited plans to offer early settlement discount of what percent? You see the note number 3, 1.5% for payment within 15 days and extend maximum credit offered to how many days? So this question has a discount. This one had no discount. So before there is no discount, but after they have given you a discount of 1.5%. It is 1.5% of the credit sales. So you will include there before, so you have discount. So before it is not given, it is 0, isn't it? But after you get 1.5% of the credit, it is among the expenses. It will be among the expenses. Then the note number 4, the company expects that these changes will increase annual credit sales by what percent? 5%. So before, so they gave us 6 million. So after you increase those sales of 6 million by 5%, so that you get now after the change, then additional incremental cost will equal to how much? 0. So there is additional costs among the expenses. You see, among the expenses, you will include their additional cost. So that additional cost is not there before, but after it will be 0.5% of assets. The same case I've explained for the discount. Discount before you put there a dash, but after you get 1.5% of, but then also additional cost the same. The note number 5, discount is expected to be taken by 30% of the customers. So now your discount. See, the sales are, let's say, 75 million, but only 30% will take the discount. So you get 30% of 75, then multiply by the discount rate. But they are saying that only 30% will do what? Will take the discount, while the remaining customers will take on average 60 days to pay. So evaluate whether the proposed change in the credit policy will increase the profitability. So even this one has no tax. So simply get before the change, do all the work as though you have done. Then compare whether there is an increase in the profit. But there is also this opportunity of debtors. So that one, the average collection period before it was 30 days. Before, you see in the note number 1, it is 30 days. Then after you got the note number 3, it is how many days? 60 days. Yeah, so that's now the question. It is similar to what we have done. But now when you get such a question, you can see the format. What was interested is only the format, how you can go about it. So for now, I don't want to do more questions for you. That one is enough for you to have. Just to get the structure, just there is a question on that. So I want us to conclude it from that point and see how it will be able to work for all of us. So when are you sitting for this? I find it Tuesday. Yeah, so that paper, like now the one for the last sitting, it has so many theories, at least 30%. It has theories of at least 30%. So when it comes to theory, it has no standard answer. Theory has no standard answer. Just write something brief on what they have asked on that theory. Sometimes if you have no answer, just use some common sense and write something on it. Because when the questions are hard, the computation, the theory they normally award 3 marks, and only for those who have attempted. Only those who have written something. If you write something on it, they will give you some marks. So make sure that all the theory questions you do, you write. That means you budget your time. Don't spend more than 40 minutes on one question. Once you have spent 40, leave that question, start another question, because it is easier to get some marks at the start than the end. So budget your time. You make sure that you attempt all the 5 questions by budgeting your time. Spend 40 minutes on each question, then you move like that. If you have spent more than 40, then it is affecting you in another question. So balance it out like that. Then when it comes to calculation, there are 3 major areas they will always test you on. The first one is the risk analysis. That one is a must. All the sittings, there have been a question on risk analysis. How to get the standard deviation, how to get the coefficient of variation, correlation coefficient, percentage of risk minimization. Make sure that you go back and read that part. All sittings, they have had that question, including the one for the last sitting. So make sure that you read that risk analysis. The other topic is marginal cost of capital or weighted average cost of capital. They pick one of them, the marginal weighted average cost of capital or the weighted average cost of capital. Last sitting, it was the weighted average cost of capital. So they are likely to repeat, or they may give you, but the concept is the same. The concept is the same. So make sure that you go through that part of the weighted average cost of capital and the weighted marginal cost. That's now the second part. The part number 3 is working capital management. working capital management. They must test you a question on that. Yeah, either cash management, this one is status management, or preparing that element of the current asset minus the current liability. You have all that concept. Make sure that you go through that portion. Then those are now the three key areas they must evaluate you on the capital, on the financial management. Then after that, now go to the capital budgeting. Remember NPV, IRR, but most of the time at your level, they test you on the replacement analysis. They normally test you on replacement analysis. There was no question in the last sitting on the replacement. There was no question in the last sitting on the replacement. So check through that part of the replacement, how you can go about to replace the asset, how you can be able to go about to replace that asset. So that's now what I will be able to advise you on the basis of what we have done. Then that element of the ratios, they must give you something on it. Ratios, just read through what is there in the ratios and come up, because it is a measure of performance. It is a measure of performance. So those are now the key areas that they are always able to come up with. Then the rest, just go through them. Like you see that part of the percentage of sales method and the cash budget. The last time they tested is what we have done for the cash budget. It was the way back in 2017, isn't it? Then for the percentage of sales, it was 2016. They have not tested at all. But for me, I always feel it is better to have some knowledge on it, just in case they come up with something on that area. Otherwise, go to the first topic, read that introduction to the financial management. They normally ask you conflict of interest, how to resolve them. You have seen them in the question. Also read through the sources of finance. Get them, they will test you something, just something small. But when you have read, even if you don't understand, you can write something. That is the sources of finance. There is also the financial markets. There is also the handout I gave you for the financial markets. So make sure that you have seen something through them. Then make sure that you are able to answer all the 5 questions. Otherwise, for now, there is no more that I can be able to explain on that. What you need to do for computation, just use the notes. Well, because all the questions you have done are from the past papers. So just use the notes and see what can be able to work for you better for that. So in case you have any question, you can simply ask, because I'm always around. So we stop there, and success in your exams.